Good afternoon, everyone, and welcome to the IC24 webinar series. We're getting to the end of 2024. Our webinar series continues well into 2025. But I have to say, we're already in the midst of preparing to be in Calgary at the end of May for IC25. We're excited. We're excited to go back to Calgary, which we have not been since 2018. We're excited because of the momentum that we're seeing in the Calgary market and really bringing together our community. And stay tuned, we're already well advanced in terms of the agenda. We've locked in some keynote speakers, and we're trying to be creative in terms of creating experiences and things for you that go beyond what you usually see from us for the Invest conference. These webinars come and are attached to the partnerships that we have with Invest. The partner that we're doing this with today is one that is steadfast. Bennett and Jones has been by CVCA's side for years. I'm thinking about Gary Soloway, who's leaving our board in a few weeks, months until our AGM, who's been there as long as I've been there, who's been there as long as Elaine Bedell has been there and like pre-seed. So, and his commitment to the CVCA and what he's done in terms of thinking strategically about helping our ecosystem with a group of peers and other firms in terms of model documents and helping with fund formation. And today, that's the topic that we're going to talk about. We're going to talk about first-time fund formation. And I was saying to our panelists, there can be no better topic. C'est un sujet très important. Le CVCA, depuis un an, se penche sur les questions qui sont importantes pour les fonds émergents. So emerging managers, you've seen at the Invest conference, the side program that we had. We had a webinar earlier in the year to kind of get a sense of what we should talk about. You saw that we did our mixer LP, GP for emerging managers. And today, what we're going to do is walk you through what you should think about, what you should potentially avoid, because people have had failures in the past, and the panelists will engage in that conversation, which will be moderated by one of the partners at Bennett and Jones. Elizabeth Dylke is going to manage this conversation. She's going to introduce you to the fabulous people that she's assembled around her to do this. I'm going to pass the floor over to her, and I will be back at the end to say goodbye to you and talk to you about the last webinar that we'll be having in a few weeks. I'll remind everyone that this is meant to be an interactive session, so there's a Q&A button, and Elizabeth and her panelists will be keeping an eye on your questions. And this is always made better by you jumping in and asking what's top of mind. So without further ado, Elizabeth, the floor is yours, and to everyone, the floor is yours, and to everyone who's participating today. Thank you so much for doing this with CVCA. Your thoughts, your comments, and your wisdom in terms of what you've accomplished and done and avoided and succeeded in doing in terms of first fund formation will be to benefit to everyone listening. So the floor is yours, Elizabeth.
That's great. That's great. Thank you so much, Kim. Just wanted to start off by thanking Kim and Stephanie and the CVCA for providing us with the platform to connect with the industry and share some ideas today. Just to start off by introducing myself, Elizabeth Dylke. I am a co-head of the Private Equity and Investment Funds Group at Bennett Jones, a partner in the Vancouver office, and previously practiced in New York. So the time slot that CVCA allotted us with today, we're going to use to lead a discussion in navigating the formation of a first-time fund in the context of a real-life sponsor example. That sponsor being Longhouse Capital, which you'll hear a lot about, an Indigenous-owned asset manager, which is in the midst of raising a first-time infrastructure debt fund targeted at $1 billion, and now planning a first close in Q1. So just to take a moment to introduce our panelists. Jonathan McCullough is an expert in funds and private equity, a partner in Bennett Jones Vancouver's office. John has a long history of acting for both sponsors and institutional investors. He was the first ever to act for BCI in the 90s. Before it was BCI even, which happened to be one of the first institutions after CDPQ to invest in private investments. So as more institutions and pensions followed suit, John has continued as a pioneer and expert in the space. Julia Wang, a partner and tax expert in our Montreal office. Julia provides specialized tax advice in private equity, M&A, and funds. Julia spent a number of years practicing at another national Canadian law firm prior to, lucky for us, joining Bennett Jones in 2023 to help launch and build our Montreal office. Fred de Blasio is one of Longhouse Capital's co-founders. He is a proud member of the Huron-Wendat Nation and a 25-year veteran finance and corporate development executive leader with demonstrated success in bridging the business gap between Bay Street / Wall Street and First Nations. Fred began his career on Wall Street and progressed to various executive business development roles at AT&T, TELUS, and the Inchikai Development Corporation of the Squamish Nation. Paul Cugno is Longhouse Capital's other co-founder. He is a seasoned leveraged finance professional with more than 25 years of Wall Street experience, who has successfully built and led global origination and credit underwriting teams for energy, infrastructure, and power sectors at Lehman Brothers, Barclays, and Jefferies, and has successfully led hundreds of private credit deals, public and private acquisitions, recaps, and restructurings, just to name a few. And Walt Jackson. Walt has a long history of raising first-time debt funds, most recently at Onex Credit. He raised a $1.3 billion first-time direct lending fund, and previously with Goldman Sachs raised a $10.3 billion loan fund. And in addition, he also brings experience from the investor side of the equation. Once upon a time at Scotiabank, he was part of a team that invested in large cap PE funds like KKR and Carlyle. So we have a broad range of perspectives here. And before we launch into questions and a discussion with the panelists, I thought I'd just set the stage with a few comments on the current market. Longhouse came to us at Bennett Jones in May of 2022 and actively began fundraising the following year in the midst of what has turned out to be one of the most difficult fundraising environments over the past decade. So just to provide some data that we pulled from Preqin, each of 2021 and 2022 saw more than 400 billion US in capital raised. In 2023, that number fell to 325 billion and now sits at 277 billion at the end of Q3 in 2024. The number of fund closings has also dropped from almost 700 in 2021 to just 249 in 2024 at the end of Q3. So interestingly, the average fund size has doubled from about 650 million to more than 1.3 billion. Also, average fundraising periods have been extended from 18 to 28 months over the past 3 years. So these stats being indicative of the fact that LPs are being measured in their investment decisions and have been more focused than ever on large established fund managers, leaving less capital on the table for new fund investments. With respect to infrastructure in particular, despite the depth of the need to fund global infrastructure projects, infrastructure capital raised is also down. Another pre-Quinn stat in Q3 of 2024, 15.5 billion was raised by infrastructure funds, which is equal to only half of the long-term quarterly average since 2017. So there's definitely a market opportunity for sponsors looking to raise infrastructure funds, even with no formal track record. But in this market, it's more important than ever for them to demonstrate a compelling investment strategy and a unique origination edge. So I'll just pause there and turn it over to Paul and Fred for the context. Perhaps you can start by telling us about Longhouse's investment strategy.
Good morning, good afternoon, depending on where you're in Canada. So Longhouse, by way of background, is an Indigenous majority-owned and led alternative asset management firm. And we believe we're amongst the first at an institutional scale in North America. And what we've done is created a nexus of activity between experts from Wall Street and Bay Street, as well as senior Indigenous leaders across the country, to assist First Nations in delivering on the massive infrastructure opportunity that has arisen in Canada, specifically as a result of the adoption of or ratification of UNDRIP by Canadian Parliament in 2021. And what that means is that, Article 32.2 states the duty to consult or free, prior, and informed consent, which has been a plate tectonic shift, quite candidly, in terms of the legal framework in this country and how you deal with First Nations. The best example of that is some of the proponents, notably in Ontario, like Hydro One, who have essentially issued an equity call option for First Nations to participate in their transmission lines. These are assets that you would otherwise not have access to. And what we do at Longhouse is essentially get institutional dollars from large LPs, think Maple Leaf and large insurance companies. And we then turn around and provide that capital to First Nations in order to be full and equal participants in, as I explained, the Hydro One transmission lines as an example. And the interesting thing is we're seeing this take place across the country. Notably, Hydro-Quebec put their strategic plan out earlier this year. It was if it could be summarized in 5 key bullet points, and bullet point number 4 was specifically the engagement and participation of First Nations and Indigenous people across the country in their projects in Quebec. Similarly, here in British Columbia, where I live, BC Hydro, in their approach to participation of First Nations, have done the same thing. First Nations have been offered a minimum of 25% equity participation in their projects, up to as much as 50%. And the higher you go in terms of First Nations participations, the better the discounts you get. And so there's a real massive change in the way the world has changed in Canada. And at Longhouse, we have really 2 main and critical goals. One is to deliver attractive market-based returns. So we are non-concessionary, we are market-based capital. But additionally, given our heritage, we put a significant emphasis on having a lasting and positive impact on Indigenous communities across the country. And we do that in a couple of different ways. One of the ways is what we refer to as the 555 program. So we actually gifted 5% of the GP to 10 First Nations. We've gifted 5% of the carry, and we've committed our partners' time to at least 5% of it being involved in what we refer to as the SIM program, or scholarship, internship, and mentorship. And proud to say that we actually ran with the folks you see from Longhouse on this webinar, the first ever Longhouse analyst training program this summer, and we had 22 kids from across Turtle Island. So think that's in our world, that would be Canada and the US, and we had 8 Indigenous kids. So these are the types of things that we do at Longhouse, and we are incredibly excited by the total addressable market in this country. McKinsey published a report in May of 2023 And in that report, they suggest that there's a $200 billion per annum gap on infrastructure investments in this country through to 2030. So let's round that up to about $1.5 trillion. And as the numbers that Elizabeth referenced, we're seeing capital inflows and infrastructure funds continue to drop. So we're pretty excited about the opportunity that it represents for Longhouse, and particularly because we're Indigenous and the unique origination edge we have because of the deep connectivity we have in communities. We feel that we are going to have a really successful array of transactions over the course of the next few years as we attempt to meet the infrastructure requirements of the country. So Paul, I don't know if you'd like to add anything to supplement that.
And Paul, well, both of you, I think it would be good to just kind of comment more generally also on the key aspects of a compelling investment strategy, especially for a first-time fund manager. Tell us a little bit about your journey, what's worked and what hasn't in terms of getting in front of investors in this context.
Sure. I'll jump on that, Elizabeth. So a big part of the journey is the preparation. And it was very clear to us early on as an emerging manager that we needed to get a strong team of professionals around us. So the folks at Bennett Jones, Deloitte, Latham & Watkins, Kroll, all of the professionals who can help you think about structure as you come up with the strategy, because those two need to go together. And if you think about sort of the 5 things that we hear from LPs when we sit down in front of them about our strategy, they want to know, Fred touched on it, what's the size of the market, who your competitors are. They're very focused on the returns. Where does this fit in their investment portfolios? Is it debt? Is it infra? Is it in between? So we've had lots of conversations with investors around that. And that also speaks to the type of assets that we're investing in terms of asset selection. How high quality are they? What does your portfolio look like? Fred hit on it. Like they're not looking for Me Too funds. They want to know, what is your origination edge? And so we've had long conversations about the unique partnership that we've created between Indigenous business leaders and finance professionals with extensive experience in the credit markets and how we can bridge that gap. And that's resonated. And then the next piece of it is, who's your team? Where do these folks come from? Who are they? If you're not a direct carve out of, say, Goldman Sachs or some of the other large asset managers, they want to understand how the incentives are created, both for alignment between the LPs, the team members for longevity, and frankly, also, what are we delivering for the First Nations as we talk about being a majority-owned Indigenous alternative asset manager? What does that mean? How do they benefit? And a big part of it, candidly, has been helping folks understand that this is a economically driven, attractive market-based returns that we're delivering with a very strong credit profile, but at the same time, the benefit that inures to the communities because they now have access to capital. And through some of the other programs that we run at no cost to the investors, to the LPs, we deliver skills, financial skills, capacity building for them. And then finally, and this sort of comes full circle to putting a strong team around you as a first-time fund, the US is extremely advanced in terms of emerging manager programs run by investors. We see a little less of that in Canada. So it's even more important in the Canadian context to ensure that we had a strong team of professionals to help us with structuring, the enabling infrastructure, fund management, all of the blocking and tackling that needs to go inside of a first-time fund. I don't know, Fred, if you want to add anything to that, but that's...
No, I mean, we're just incredibly grateful to Bennett Jones and their support from the outset. And we wouldn't be where we're at today without their steadfast support. So just a little shout out for the team.
Yeah.
Thank you. I mean, we're very honored to be involved in such an exciting project. So just on that note, going to some of the structural considerations, I'll turn to the lawyers on the panel. There are a number of structural considerations that are typically driven by tax and from a commercial standpoint, liability. So I'll turn it over to Julia to talk about what kind of tax considerations come into play when structuring a fund for the first time.
Thank you, Elizabeth. So obviously taxing every day is a decision-making process. So in a fund, in a first-time investment fund setup context, it's not foreign to that as well. In the structure discussion that you're gonna have, it's coming handy because you need to know your audience. You need to know the investor, what they're worried about, what they're concerned about, and what they're interested in their discussion. So you need to be prepared for that. A few items coming to mind that as just a preliminary thinking is who will be the targeted investors? Who are you planning to approach to? Are we talking about Canadian investors? Are we talking about foreign investors? Because that will be a driver to the structure of the fund you want to put in place. Some of the parallel funds, for example, are meant to be to accommodate the request from the Canadian investors to be in a fund that will be only open to Canadian investors, just because there's such a thing that's called Canadian partnership under our tax rules. So if you are adding foreign investors in your in the potential investor you're targeting to, then that will create a more complexity to your fund structure.
Just to make one quick point from a corporate standpoint, what we typically tend to do, because it's sometimes a moving target in terms of, you know, what investors come into play. So with the main fund documents, we'll just make sure that we build in all of the plumbing so that we have the flexibility to set up AIVs and parallel funds internationally and in the US, so that if fundraising takes off in those markets, that we have that flexibility.
Absolutely. So the fund documents themselves will be flexible, but the structure chart where when you're approaching the targeted investor and you telling the investor into which AIV or parallel fund the investor will come in discussion. So that has to be thought ahead of time. The other thing you need to keep in mind is the tax profile of the investor. It doesn't matter we're talking about Canadian or foreign investors, the tax profile is very important. Are we talking about taxable investors? Are we talking about tax-exempt investors? Obviously, they have different concern. Tax-exempt usually try to avoid any kind of entity-level tax. They would want to invest into a flow-through or transparent fund entity. And even among the tax-exempt investors, you will have different type of tax-exempt investors. You will have crown corporations, you will have pension funds, you will have charities. They all have different type of different considerations, and they will all raise different type of questions. So depending how broad you will go after these targeted investors, you need to just be prepared at the question they may raise, and that will have an impact as to the complexity of the fund structure. So that's to the audience. That's the number one item to be considered. The second one is as to the fund manager, the team of fund managers. Who are they? Where are they? Are we talking about just purely Canadian resident fund managers? Are we talking about fund manager in another jurisdiction? That will add another layer of complexity, because if we're talking multi-jurisdictions, then it will be a matter of structure, the fund structure, and the compensation of the fund manager in a tax efficient way that takes into consideration tax rule in different countries. So the cross-border the structure of the cross-border carry interest has been a very complex discussion among tax professionals in the fund space. The third item to be considered in its active discussion, you will get that kind of question for your targeted investors, is the type of income that will be derived by the fund. So are we talking about capital gains? Are we talking about dividend income? Are we talking about interest income? So that would change a little bit how the fund should be structured, and also the industry in which the fund is targeting. Is the fund targeting industry like a biotech or tech company that are not heavy in real estate investments, or are we talking about real estate investment funds? Because there are certain rules that are unfriendly to non-resident investors, and that you will have to take into consideration in the structure you fund. In the context of a real estate heavy fund, for example, if you have non-resident investors, we will have to deal with what we call taxable Canadian property rules under the Canadian rules, and that can trigger some withholding tax issues whenever the investor is exiting from the fund, or whenever there are potential distribution to the non-resident investors. So all those questions needs to be thought ahead of time before your first meeting with your anchor investor, because necessarily some of the questions they will want to know, you might not get into the nitty-gritty of the discussion, but they will want to know that you have thought about these considerations, that you're well prepared, because that shows that whether you're expert in your area or not. Another consideration that come to mind is the jurisdiction of your investment. Are you making investment purely in Canada, or are you making investment in the US or the rest of the world? Because that will trigger some foreign tax considerations to the fund itself and to your investors. If you are a fund that invests in the US and you're targeting some of the Canadian pension funds, let's say Crown Corporation, they will have particular concern as to income derived from the US. They will want to avoid as much possible and benefit from their particular status that give them certain exemptions from US source income, and they would not want, and that's a big concern to a lot of Canadian pension funds and Crown Corporation. They would not want to have an obligation to file a tax return in the US simply because of their investment in the fund. So that would be something to keep in mind as well. And finally, the type of portfolio investment you're going to make. Are you planning to make investment into corporations that are usually viewed as a blocked entity, or are you making investment into a flow-through entity, another partnership that all the income, all the tax risk will flow through that entity as well? Then there are certain concerns that, for example, the tax exempt will have at your fund level. They won't want to make sure that you're getting the same concern answer when you're making investment in an underlying flow-through entity. So these are the type of things that you should keep in mind and you should check.
Yeah. No, that's very helpful. I think from a tax standpoint, why don't we hear from John McCullough on the corporate considerations and how the jurisdictions come into play? Just before you start, you're on mute, John.
Thanks, Elizabeth. Yeah, as Julia said, typically the structure is driven by tax. And if you anticipate having tax-exempt investors, that means you're likely forming a flow-through vehicle, and almost all of the time it's a limited partnership. Sometimes you see trusts. You don't really see corporations unless your limited partners are taxpayers. In Canada, we have relatively antiquated legislation. The best of it is in Ontario. It's the most modern and it's the most flexible. And for that reason, it's the choice for many fund sponsors. Because many of the institutional investors are also very concerned about liability, they may insist on organizing in Manitoba. Manitoba has a better limited liability regime. There's a question in Canada because of the absence of case law about how you lose limited liability in a limited partnership. One of the ways to do that is by taking part in the management or the business of the partnership. And that raises all kinds of concerns about, is my participation on an LPAC or advisory committee taking part in the business? Is my veto on certain matters taking part in the business? Those concerns don't come up in Manitoba because Manitoba makes it clear that your liability is only to creditors who aren't aware of your status as a limited partner. So purely internal discussions aren't going to threaten your limited liability.
So for any US viewers, I think it's similar to Delaware. Just a note on that.
Correct, yeah. And for parallel funds, for US investors, Delaware is the gold standard. It's absolutely the most sophisticated and flexible piece of legislation. There's lots of common law that tells you what all of the things mean. Cayman is also a very popular choice, modeled on Delaware, very modern statute, not the same level of case law. Luxembourg, also very sophisticated, very different though as a civil law jurisdiction. Another thing that first-time managers should be aware of before they get into the process is securities regulation. In Canada, that regulates both dealing activities and advising activities. The good news is that for long-term closed-end funds, there is a very broad exemption from both the dealer registration and the investment fund manager requirements for private equity and venture capital investors. And essentially, you are entitled to sell to accredited investors as long as there's no compensation for it. And you're allowed to provide investment advice without registration, so long as you have a level of control over your investment. And that's measured by participation on the board, the ability to have negative covenants or vetoes, and so on. So the distinction is between a long-term investor and somebody who's perhaps just picking stocks off of an index. Anyway, so that's a very high, brief overview of Canadian corporate and securities considerations.
No, that's great. And I think that it's one thing that emerging managers are happy to avoid because it is quite a lengthy process to get registered in Canada, similar to in the US. It creates an additional compliance burden. Why don't we hear from Paul and Fred while we're on the topic, given that Longhouse has management individuals on both sides of the border, has an Indigenous ownership requirement. How did you juggle the interests of the various jurisdictions just in a few minutes? And then we'll turn to Walt. You're on mute still, Paul, just make sure.
Sorry, I do my best working on mute. Just it is a juggling act, and I sort of go back to something I said early on in the journey as an emerging manager. You have to have sophisticated professionals giving you advice, because to Julia's point, when you get in front of the initial LPs, when you're looking for your anchor, which Walt will cover, it's critically important that you've thought about structure. So in our case, we have the First Nations themselves. We have who are equity owners. We have Indigenous leaders who live on reserve in most cases. So they have things to consider. We have Canadian residents who we need to consider. Part of the investment team is based in Canada, and we have US based employees for expansion of the firm over time. That sort of what Julie and John just went through was critically important. And then John touched on the regulatory oversight. We're operating on both sides of the border. We've approached LPs who are both in Canada and in the United States and in Europe. So you have to think about the structure and what is important to them, whether they're taxable or non-taxable entities. So all of that, even though it sounds like really what you're focused on, importantly, the first order of business is to come up with a strategy that is investable, that is rather unique, and that will deliver value to the LPs in the long haul. You have to think through the underlying structure so that you can actually deliver on that promise to them in an effective and legal manner. And Fred and I have spent countless weekends on the phone with John and Elizabeth and advisors from Deloitte, just working through those detailed tax structures. So critically important. It can be done in parallel, but important to think about. I don't know, Fred, if you want to chime in on some of the complexity there.
No, that's great. Thanks, Paul. We'll let Walt talk about the investor side. There's a question that came in, and this is in line with what I was about to ask. The question is, how did you find your LPs? Please tell us how long it took to build relationships with these organizations and where you started. So the question I was going to address to Walt is the importance of finding a significant anchor investor. In our experience, once that happens, a number of investors tend to fall in line, but this is obviously a challenge for first-time fund managers who don't have a formal track record to build that relationship with a significant anchor. So Walt, who has raised a few first-time funds, perhaps you can tell us about some of your experiences, what their kinds of things that these investors are looking for, what's worked and what hasn't.
Sure, I'll cover the key issues around anchor LPs. I'll also try to hit on how did we find them. So across my career, which has been very long, I spent most of my time financing buyouts for US, European, and even Canadian PE firms. I also spent time on both the fundraising and fund investing side in raising funds. So I made institutional investments in private equity. I made personal fund investments across private equity, credit, infrastructure, and venture capital. And then from the buy side, I helped raise funds in private credit. And two of those were first-time funds. So way back in the 90s, I was at Scotiabank, and we invested in selected large cap PE funds in order to drive leverage finance volume. So we had a very successful US-based leverage finance business, and we made fund investments to help drive opportunities. And we did that with KKR, Carlyle in the early days, InvestCorp, Hicks Muse, AEA Investors. Most of those are still prominent private equity firms. At Goldman, we raised GS Loan Partners 1 in 2008. That was a first-time loan fund inside of the merchant bank. The merchant bank at Goldman is sort of like a miniature Blackstone inside of the firm, in that they do private equity, infrastructure, real estate, and mezzanine, but they had never done loans. So we raised a $10.5 billion loan fund, as Elizabeth mentioned, that financed large cap private equity transactions for large PE funds. It was primarily senior secured first lien loans to non-cyclical, non-capital intensive companies. In that particular case, our anchor investor was ATP Denmark, which was a large Danish pension. They invested over $1 billion in the equity of that fund, and then additional amounts in that fund's fund financing. Their investment was so large that they had to go to the government to get approval to make the investment. It was a great decision because that fund produced gross IRR of about 31% and over 2 times MOIC, outperforming most of the private equity funds of the same vintage. Later on at Onex Credit in 2017, we raised Onex Credit Loan Partners 1, also a first-time direct lending fund, under the Onex Corporation umbrella. Again, Onex had a long track record of raising funds, but they had never raised funds in loans, direct lending loans. OCLP was a $1.3 billion fund focused on middle market PE transactions and selected secondary loans. Again, primarily first lien senior secured, again, private equity centric. And our anchor investor in that transaction was Onex Corp itself, the publicly traded company, and PSP, the Canadian pension plan. To the question of how did we find them, obviously Onex was our sponsor, but PSP was via a relationship. One of the senior people at PSP was building a credit platform, and he was looking for a sourcing partner. And we were a bit farther along than he was in terms of building relationships with private equity firms. So PSP invested in that fund based on a long-standing relationship. So now on to the most significant challenges for first-time funds. It's a pretty long list, but I would say the 3 most important factors are quality of the team, the track record and attribution of the track record, and then the alignment of interest. There's other factors that are important as well. Platform and fund structure, which we've talked about, fees and fees discounts, which we'll talk about a little later, and then the relationships with the LPs. So on the team,
when you say track record, you mean track record of the individuals?
Yes, it's both. It's actually track record of the individuals raising the fund and the platform they're attached to, if they're attached to a platform. So at Goldman, we had many, many years of experience in underwriting and distributing debt, but we had never raised a loan fund to invest in debt. And so there were questions around that, like, why do you guys think you can be good credit investors? And one of the answers to that was, well, we're investors broadly defined, and I've spent the last 20 years investing as a value investor, and I view credit as quite similar to that in terms of how you think about risk. So what investors are looking for is proof that you can actually do what you said you're going to do, and you can do it well. At Goldman, it was a little easier because you're under the big umbrella. And so while they didn't have experience, we didn't have experience in raising loan funds. We had experience in raising mezz funds, private equity funds, infrastructure funds, real estate funds, and there was a deep bench. So if something had happened to myself or the other founding partner, there were people that could step into that role and pick up the ball. At Onex, to your same question, Onex had never raised a direct lending fund, but they had experience in adjacencies of investing in debt. And then we leaned a bit on the track record that myself and my team had from Goldman, even though it wasn't transferable. And that's sort of a legal question you've got to get advice on. Because we had done it before, people sort of looked at that and said, well, look what they did before. That's pretty indicative of a belief that we can do it again.
Mm-hmm. No, that's no, those are interesting war stories. In the context of attracting a first-time investor, especially when you are a first-time fund, I think that it tends to be a playing field where there's quite a bit of negotiation. Sometimes we see these well-established fund managers, and when we're acting for LPs, we don't really have a whole lot of bargaining power at all once they've established, a 10 or 20 year record with great returns and have grown to 30 billion or however big they get. So I guess just wanted to address some of the conversations that have taken place around creative structuring or trends that LPs may be looking for, or even on the sponsor side to address the unique positioning of the first time sponsor. So maybe John, I can get you to just talk quickly about structuring the GP commitment and offset. You went back on mute, just so you know. And then we'll move to fee arrangements.
Thank you. Thanks for your reminder too, Elizabeth. So with respect to LPs and institutional LPs in particular, not much has really changed in the 30 years or so I've been doing it. The first thing that they're looking for is alignment. And that means what's good for you is good for me. And that's where the carry comes in. And what's bad for you is bad for me. That's where the sponsor commitment comes in. And it's meant to be, it's meant to do exactly that, create alignment. For a first-time fund, that can be really problematic because you don't have the carry from your last fund to invest in the next one. And the challenge is going to show that you have a really meaningful commitment, and that if the fund doesn't perform, it's going to hurt. So how do you do that? One of the techniques that sponsors have done more often in the US is to make their commitment via a reduction in the management fee. And that itself is a bit problematic because the LPs look at the management fee and say, this is not supposed to be a source of profit. You're supposed to be covering your costs. So if you're going to reduce your management fee, that probably means you're getting too much of a management fee. And Julia can chip in as well. There are some significant tax considerations with respect to structuring that as well. I guess the other thing to keep in mind is that in attracting your anchor investor, they're going to want something. They're taking a risk beyond what the other investors are taking. And for that, they're going to want something back. And sometimes that takes the form of a piece of the GP, a piece of the carry, certainly a discounted fee set. And one that's become pretty common and is related to the discounted fee set is co-investment requirements. So firm and fixed requirements on offering up co-investment, the effect of which will be if there is no fee or no carry on the co-invest, or a reduced fee and reduced carry, you can look at a blended fee set, which will reduce the management fee and carry across the fund and the co-investment set. So that's kind of what we've seen in some of the challenges that a first-time manager encounters.
Julia, maybe do you want to take a quick minute to talk about sort of what are some of the tax considerations when structuring fees before we hear from Paul and Fred as to what investors have been asking them for in terms of fee discounts and special arrangements?
Sure. So in a typical, let's say, venture capital fund structure, nowadays we've gone through several rounds of different structures. So nowadays we're seeing a steady trend of 2% back to 2% management fee, 8% preferred return, and 20% carry interest. That's the typical one. Obviously, the percentage might be subject to negotiation between the parties, but that's the typical one. And the carries, it's typically paid to a carry entity, a carry limited partnership. Whereas the management fee, 2% management fee, is either paid to a management corporation, a separate entity, or to the GP. So we are starting. So the 2% management fee is ordinary income in the hands of the management corporation. We're now seeing more and more another train coming along, and there are several funds out there pushing forward this train. Is the 2% management fee will be structured as a another partnership distribution, so that it has a certain benefit to the sponsors. So it will be part of the waterfall, whereas the 2% management fee itself will not be part of the waterfall in terms of distribution. So there are certain trends as to how the sponsors are being compensated, and there are pros and cons in terms of why we should structure in such a way, and certain risk as associated with the structure as well. It's all subject to discussion, is all subject to what's the underlying income stream. This is relevant because the expected underlying income stream is capital gain. But if we're talking about interest income, it will be different, entirely different discussion, for example.
Paul, do you want to talk about any of the kind of particular discussions that you've had with investors on these points?
Sure, let's make sure Fred and Walt chime in here. Just to circle back to the question about how do you find that anchor LP and build the relationships, it's your network, and that's why having like an extensive group of professionals as professional advisors, and frankly strategic advisors like Walt, who've been to this movie, even though our team has multi decades of experience and is 4 times as deep as me and Fred on the call here. It's really relationships, it's existing network, and then it's the warm introduction is always the best, and it's working your way through the organizations. And buckle up, it's going to take a while. Even when you have long-term relationships, it could take you a year or 2 to get people comfortable that your investment strategy as emerging manager is suitable for where they want to be. And you can't time some of the challenges we've run into. Fred, I don't know if you and Walt want to chime in on that as well.
Yeah, I think the word that comes to mind is grit. Quite candidly, because Elizabeth noted that the final close used to be roughly 18 months, now extended to 28 months. And make no mistake, for those first timers out there on the webinar, notwithstanding the spelling, there is no fun in fundraising. You got to have a short memory and thick skin, because you got to take the beatings and you got to keep going. And when somebody says no, you say, "Oh, great, I'm going to see you next week. When should we pencil that in?" You just have to have that staying power, and you have to keep going at it. If we had $1 million for every time we were told we were a first-time fund, as if we didn't know, we'd be halfway to our goal, quite candidly. So, you've just got to accept those types of things and just stay true to the mission. And the places where we get, sort of beaten up on are typical, and John touched on these. Discounts. And so the way you can sort of mitigate some of the dialogue related to that is to say, "Hey, look, we'll give you discounts, but you've got to come to the table with an appropriate quantum that justifies that discount." And of course, you want to put a fuse to it. So you want to create a timing issue that is at first close to get the motivation to move forward. Another one of the questions that we often get asked about is governance. And as Paul pointed out, we've got a rather experienced team. Notwithstanding that, the governance as a first-time fund is something that LP investors are quite focused on. And so there are a couple of ways you can structure around that. One of the ways that we've tossed around is having an LP investor on your IC as an example, and you have a unanimous voting approach. So that provides them with some comfort. And John also pointed on this, the big thing we're seeing is co-investments, because everyone is incredibly fee sensitive. And so what we're seeing in the marketplace these days is a roughly 3x on the, so if in other words, if an LP is putting in 100 million, they're wanting an extra 300 so that they can amortize those fees over, the full 400 million. And that's another area where you can attract capital. So those would be the big items. I don't know, Walt, if there's anything else you'd add to that.
The only one other thing I would add is just the relationship trust factor, right? So Paul mentioned network. Most of the people we've met who've engaged with us knew us knew Fred or knew Paul or knew me or knew some combination of all of us over many years. And so there's a trust factor that helps you get that first meeting and get an audience with, Canadian Pension or another institutional investor. And that's really important to kind of getting the ball rolling.
No, that's great. We have one other question, a couple minutes here for questions. And there's a question that came from the audience, which maybe Walt can answer. Not sure how far Paul and Fred are down this path, but did you find it difficult getting credit facilities, for example, hedging currency exposure for new fund launches, especially with AIVs, SPVs, and foreign sleeves where there's a lack of financials and track record?
Yeah, there's a whole massive ecosystem in the U.S. for fund financing. It ebbs and flows with the broader markets, but it's very important, depending on the nature of the fund. For credit funds, it's essential. You need fund financing, both subscription lines and asset facilities. For the strategy that we were running, both at Goldman and Onex, relatively straightforward because the quality of the assets underlying the investments is very high. And so you could get very attractive fund financing. I ran the fund financing at Goldman for a number of years, and we raised debt facilities across credit, loans, mezz, infrastructure, real estate, and private equity even. For different strategies, so venture capital, fund financing is harder, but there are providers, and you just got to figure out who they are and what they're interested in doing. So yeah, in the US, there's a big ecosystem, probably less so in Canada. But I do know that some of the banks are pretty aggressive in and around relationship lending to funds.
No, that's great. Kim, do we have time? We had one more quick question. Okay, just one more quick question from the audience. Are there any comments on structure for a nonprofit owned fund looking to potentially structure a collaborative fund with government or nonprofit foundation limited partners? So I know that Paul and Fred get confused with a traditional impact fund every now and again. So maybe you want to comment on that one?
Do you want to go, Fred? Okay. Short answer is there is an ecosystem out there to provide collaborative funding for a number of nonprofit or impact focused sleeves of capital. That's not where Longhouse is playing. We're playing in the traditional private market with attractive returns. But sometimes people get confused. Unfortunately for us, look, we will have an impact in what we're doing, but it's as a function of delivering an economic solution. But I would tell you that there's Canadian government programs out there, there are US programs out there that would support what you're looking for. And happy to talk offline about that in a little more detail. It's just not the area where we've been trafficking in terms of sourcing LP dollars.
Thanks, Paul. So we're 2 minutes before the hour, and I don't see any more questions in the queue. So I think that is a good point to wrap up. So just want to thank the CVCA again and all of our panelists. It's been great having this discussion.
Thank you so much, Elizabeth. You did a fabulous job moderating this. And as I predicted, the complexity of this, the need to be well surrounded as you start, and what you can expect from LPs, their sophistication in their demands in terms of co-invest. And so the landscape in some ways doesn't change, but in some ways is evolving in terms of what people are looking for. A big thank you to all of you for participating in this conversation. And again, to Bennett Jones for partnering with us. To all of you listening, thank you for joining. We have one more left before the Christmas holidays on December 11th. Investissement Québec and I will be sitting down together and we'll be talking about fund management in Quebec. And anyone who's raising money and anyone who's doing business in this asset class knows that Quebec plays an instrumental work and role in fueling the opportunities for both investors and entrepreneurs. And I'll be spending an hour with them talking about that. To all of you who have not registered, there's just a few spots left for the CVCA holiday cocktail. It will be my last day until I go on vacation. So I will be in a festive and cheery mode. Please join us on December 12th. And if we don't see each other before then, wishing you a great end of 2024. And again, thank you for joining us today. Have a great day.
Very much.
Thank you.
Thank you. Cheers.